Global stocks are jittery and safe havens are in demand this morning after an escalation of the conflict in Ukraine overnight. The RBA's minutes indicate it may cut earlier than previously expected, and Australian consumer confidence remains trending higher. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes analyses the outlook for Chinese steel production and iron ore prices ahead of looming US tariffs under a Donald Trump presidency.
We did see output rise in October, and I suspect that's a trend we'll continue to see in the shorter term as those Chinese producers look to push more steel into the market before Trump applies those tariffs.
But first, in 5 and 5 with ANZ, traders are nervous and looking for safe havens overnight after Ukraine blew up a weapons dump inside Russia with a US-made missile. And Russia changed its nuclear response doctrine to include attacks inside its borders by allies of Ukraine. The Dow was down 0.3%, while the S&P 500 was up 0.4% by 4 a.m. Sydney-Melbourne time. Demand for safe haven assets, such as US Treasuries, firmed. The US 10-year yield was down 3 basis points at 4.38%. Meanwhile, European inflation figures overnight confirmed the battle against inflation is won, says ANZ Head of G3 Economics, Brian Martin.
The data should encourage the ECB that the battle against inflation is being won. That is allowing them to turn their attention to growth, and growth is underperforming at the moment. So we think the inflation data and the current growth environment will be consistent with the ECB continuing to ease policy. We continue to look for the policy rate to fall towards 2% in the first half of 2025.
The US dollar index was flat at 4 a.m. Sydney-Melbourne time. The Aussie dollar was up, though, 0.28% at 65.24 US cents, while the Kiwi was up 0.3% at 59.07 US cents. Number 2. The minutes for the Reserve Bank of Australia's November meeting could be interpreted as the board opening the door to rate cuts in coming months. ANZ Head of Australian Economics Adam Boyton says 2 segments stood out, albeit with guarded language.
The first was a sentence discussing the current stance of policy where the minutes said, quote, "These observations suggested that there was no immediate need to change the cash rate target." The interesting thing in that sentence is the word immediate, which I think including that conveys a slightly different message to if you'd said there was no need to change the cash rate target, full stop. And then in the next paragraph, the minutes refer to the need to be forward-looking when it comes to adjusting policy. And so just taking those things together does suggest that there may be a little door opening there to cash rate cuts.
Number 3. Adam says that doesn't mean the minutes should be classified as dovish. Rate cuts might just be a little closer than expectations. Market bets ahead of the minutes didn't have 25 basis points worth of cuts priced in until May 2025.
We're still expecting the first rate cut in February next year. The balance of the data, certainly over the past few months, would suggest the risk of that or the risk of timing around that is later rather than sooner. And then the tone from yesterday's minutes just pulls that risk in a little bit.
Number 4. ANZ Roy Morgan consumer confidence maintained the new levels it has risen to in recent weeks, up 0.1 points last week to 86.8. ANZ economist Sophia Angala says while confidence has been within a tight range, the trend remains upward.
Optimism over the next 12 months has been rising since July. Looking at the sub-indices, household confidence in the 12-month economic outlook saw the strongest gain since July, rising over 10 points. Confidence in personal finances over the next year has also risen over 8 points over the same period. Looking at the time to buy a major household item sub-index, this has also risen over 9 points since early July, and this may be supported by the boost to household disposable incomes from Stage 3 tax cuts.
Number 5. Inflation expectations in the survey have been hovering just below 5% in recent months. Sophia says there was a slight tick down in the measure last week.
Inflation expectations ticked down to 4.7% last week, and this was possibly in response to last week's Q3 wage price index print, which showed a broad-based slowdown in wage growth. And this data is likely to give the RBA more confidence that wage growth is returning to a rate consistent within its 2 to 3% target band.
Sophia Angala there. Now, for our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes takes a look at why Chinese steel output saw an unseasonal rise in October. No points for guessing why.
There's certainly a prospect of some fairly heavy tariffs on Chinese steel exports as US President-elect Donald Trump prepares to enter the White House this for the second time. Certainly the prospect of rising exports, I think, in the medium term are quite high. We saw during Trump's first term in office quite a precipitous drop in Chinese steel exports as a result of the trade war during that period. And I suspect steel producers are really gearing up for a fairly similar sort of scenario. So we expect to see exports of not only steel, crude steel itself, but also downstream steel products to really increase over the coming months as they prepare to front run, I suppose, that expected 60% tariff that Trump has warned will be applied to Chinese goods. Now, the Chinese government has certainly looking at this as well quite closely, and I think they are prepared to support industry, but also looking to increase domestic consumption as well to at least protect itself from potentially lower international demand.
So what are iron ore prices doing? What does that mean for demand?
Well, I think we expect to see stronger steel output in the shorter term. That will be exacerbated by relatively low inventories of steel. In fact, when you look at the level on a seasonal basis at the moment, we're at the bottom end of the 10-year range. So that should precipitate a pickup in steel output, which will obviously improve iron ore demand. And in fact, data just released this week showed a bit of a pickup in October volumes. So that's something we expect to see come through for demand of iron ore. It is going to support iron ore prices in the shorter term. We have seen them dip just below $100 a tonne in recent days, but I suspect as that starts to flow through, we'll start to see some level of support re-emerge for iron ore prices.
What's happening with seasonal steel output in China?
Well, we normally see steel production fall. It tends to peak in the second quarter of the year and then fall over the course of the second half of the year. But we did see output rise in October, and I suspect that's a trend we'll continue to see in the shorter term as those Chinese producers look to push more steel into the market before Trump applies those tariffs.
What's your short-term view on iron ore prices?
Well, we expect to see a little bit of weakness, but I think the downside is relatively limited. That increasing steel output should support iron ore demand, and as such, I think we'll see some sort of support return to the market. We are seeing demand for iron ore and steel being supported by other non-property sectors as well, so infrastructure, manufacturing, even areas like the auto sector and shipbuilding are all providing support. So I think for me, we expect to see iron ore prices sort of settle in that $95 to $100 a tonne mark.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, November the 20th. Catch you tomorrow with analysis of China's lending rate decisions expected later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.